Hi, investors. It's Nick.
And hi from Martin.
And we're just doing a very quick summary of our new strategy in light of the market changes. So, the strategy is find properties or buy properties, should I say, because that's what you're here for, to buy properties at below market value from motivated sellers and then hold and refinance when interest rates are very likely to decline again. Now, the strategy assumes, as I said, two major things: A, motivated sellers, B, declining interest rates. So I'm just going to quickly cover both off. Motivated sellers, there is a cost of living crisis exacerbated by cost of energy crisis, exacerbated by high interest rates. And all of this means that people are gradually running out of money. And whenever that happens, there are always a fringe group, as it were, that are sitting on equity and just have to sell for whatever reason. So, and usually it's because they're running out of money. And also the market's gone a lot quieter because of interest rates, etc. So we have this interesting situation, which is kind of gradually building up. And I've seen it over the last month and a half now. And we're starting to see motivated sellers come through and really nice properties being discounted quite heavily. And the type of property that discounts really heavily is typically something that needs quite a lot of renovation, which then takes us into the high interest rate stuff. So when interest rates are high, but people really need to get on and buy something, what they're doing is they're kind of stepping down a rung in the ladder. So whilst they would have once gone for a bigger house, they go for a smaller house. But at least they own a house, which is a good thing. So they're trading down. But what they're not doing is taking on a big cash outlay for renovation. So a lot of these houses need quite a lot of work on them. And if you're an owner occupier, why would you eat into your pile of cash that you're using as a deposit? Why would you eat into that when you could just buy a house at a lower price point, less with more equity and less cost? Uh, you would do that, right? So the whole thing that we're seeing now is that properties that are in relatively poor condition, unmodernized, are hanging around. Nice houses are hanging around. And so what we're after and what we're now finding are people who really have to get on and sell, who own houses that need quite a lot of renovation. And they're hanging around these properties and they're willing to discount. And we're seeing this already. So that's the game plan. And the process. So the way I'm doing the video is I'm going to get into more detail towards the end, so you can jump out earlier if you want to, by the way. So the process is that, Martin, will you talk about the process you're going to follow to find properties that are contenders?
Yes. So basically, we will have like a two kind of properties. One who will be reduced, and the one or like in really good area but in bad condition. So basically, we can have it for cheaper money. And the other type of property will be cash deals, who will be in okay demographic, good location, good fundamentals of the property, basically no issue with the property, and we will have plus 7% field, and the price will be, let's say, from what? From 60K to 120K. Usually it will be terrace house, 2 or 3 bedrooms, which will rent nice and which will give you decent return. So I think these kind of properties are what we will fund from now on. We'll not focus in the like in prime location, prime condition, which we cannot take it below market value, let's say.
Yeah, it's all about going for below market value property. And as I said, there is no, in a sense, there's no such thing as below market value. But in this case, there is in a way, because what happens is that sellers are willing to compromise on price for the assurance that they will get the property sold quickly before they hit the buffers, basically. So what that means is it has to be a cash purchase. Money most probably has to already be in the UK so that vendors are confident that everything's going to run smoothly and quickly. So, there are a lot of prerequisites on this, but the way it's going to work out is that you'll be able to buy a property for cheap, renovate it, hold on to it for 2 or 3 years, and then refinance when interest rates are likely to decline. Now, there is one other category which Martin forgot to mention, which is properties that have been hanging around a while. Now,
Yeah,
quite often those are not with particularly motivated sellers. They're just like, well, we see what we can sell it or whatever. But my job is to check and see if they are motivated or not. If not, we just leave, put on a diary notice, come back to it in a while and see what's going on. So for you as a client, you're going to have the idea is that you're going to have lots of choice, which is good, and something's going to give. Some buyer amongst the portfolio of properties that you're interested in will just kind of collapse and go, okay, I'm out and I'm going to discount because I have to sell. And the agent will know that you're ready to buy when the price is right. Now, the price is based on the yield, and this is the critical difference between how we used to do things, how we're going to be doing things from now on. We will have a discussion with you about what yield you find acceptable for a given type of property. So if you want a premium property, let's say Droylsden, Swinton, whatever, then there's a target yield which is acceptable. Now you might say, I want 8% gross rentable yield, i.e. cost of property plus renovation divided into rent, annual rent. You might say, I want 8.5, want 10%. Well, we say to you, sorry, that's delusional. You're not going to achieve that. So we can't help you. But if you're sensible and if we work on a stretch target for a prime area, let's say Swinton or Salford, one of these places, we might say, okay, stretch target, let's go for over 6%, for instance. And then if the property hits that number, then we're game on. If not, we're not. It's really simple. And it's simple for you, and it's simple for the agent, and it's simple for us. So that's how it's going to work. So you'll have, hopefully, if you want to work with us on this, you'll have a selection of maybe 10 properties that you like. We'll be constantly finding new ones. You say, oh, I like that one, whatever. And then we watch, we wait, we call up the agent, and someone's going to discount on one of those, probably. And once it hits the number, our threshold number that we're happy with, great, we're game on. Let's organize a viewing and then check the property out thoroughly. And if we're happy, then it's time to offer. Because why? Because it's hit a target yield that you're happy with, that makes sense for you financially, and we move on from there. So that's the process. And so let's talk about a property in hand, a case in point. And this is, so we'll just describe it really. That's the easiest thing to do. So this is a 3-bed semi-detached house in Droylsden. It's a property in place, so we're not going to show it to the whole world because, it took us quite a lot of work to get to this one. But it's a good example of a property in a prime location near the tramway. It is 3-bed, semi-detached, 70 square meters, that kind of thing.
72.
And
Yeah.
72. It's
Yeah,
got an
EPC is
EPC of
D,
six,
D,
yeah,
D,
D.
CCC, D. It needs just 3 scores to be improved, but it did a lot of renovation. It needs
So
new
the
kitchen.
the backstory is a typical Droylsden semi-detached house. And if you just look on the maps, look on the sales stuff, you'll find it. The main point, Martin, could you just bring up a couple of Droylsden houses so people can actually see what we're talking about? In the meantime, I'll explain the circumstances. So what's happened here is that the house is in need of a lot of modernization. It's on sale. It's being sold by the family of somebody who's had to go into care. And in this country, when people go into care, they are, if they have asset wealth, then they have to sell the property to pay for the care home fees. So you got people who know that the odds are they're never going to see any of this money as inheritance because it'll all get soaked up in care home fees. So they just want to get on and sell the property fairly quickly and move on with their lives and just hope that their loved ones are looked after in the care home. So therefore, they're prepared to discount. And this property needs about £25,000 renovation, which is too much for most owner occupiers because they're not feeling confident about the future. They're not going to sink a whole load of cash because if you imagine you've got 25,000 in renovation cost, you've got to stump up a load of deposit, so probably 20% in deposit. So off the bat, you're probably having to spend 55, 60,000 pounds total to purchase this house, which is just too much cash for most people. And therefore, they're not making offers. And for you as an investor, it's a great opportunity. Have you found anything yet, Martin?
Yeah.
Okay,
I
could
will
you
share
share
my
a
screen.
screen just to, yeah. So this is a
So
typical Droylsden house, and it's
yeah, this is the
classic
Dresden.
case in point.
Yes. So this is Dresden, like how close you are to A662. Yeah, it's better, but doesn't always mean. So this is like Dresden. So basically, this is an example of house 225. As you can see, this is
It's
basically
in
the
quite good
premium
condition, so
condition.
it's
Yeah.
likely that this place will sell, but maybe
So
at a slight discount.
yes. So for example, this one is also a good example. Like maybe the electrical are not the best. So the kitchen is
So
yeah,
imagine a house that needs a lot of renovations, so it hasn't been updated in maybe 30, 40 years, that kind of thing. That's what we're talking about. And it's very likely that that property will discount by 10%. In other words, from 200-ish, say
let's take
220
this one.
down to 200 or whatever. So so yeah, so
This is what
this is
yeah,
an
this
example. This is a less prime property, but you can see the condition. So this is a classic example. Now, the thing about a property like this is that if you can get it for say 240, 140 for the sake of discussion, you know that you have to put in 100, maybe 25,000 into this.
no, I think more. Just need 50 maybe.
Okay. So so this needs a lot of money in it, which is going to put off an awful lot of owner occupiers. Developers are nervous about these kind of properties because they don't know how quickly they can sell them at a profit because the market isn't rising, and developers have to sell their properties off quickly, otherwise they don't get the tax benefits of being a developer. So a lot of people are in a real kind of crunch catch 22 scenario or situation. And so I just want to share my screen. And I'm going to talk to you about the long term story here. So markets work in cycles, and they have for a very long time, since 1845 at least. And we're in the peak of another cycle. So there's a little red arrow there, and the market will decline. And what happens is that you have affordability, and the market generally snaps back to say average affordability should be, well, in this sort of period, maybe 6 times, 6.5 times, 6, 7 times average wages. And that's because of the cost of money. So when money was more expensive, it was somewhere around 4.5, 4. And now it's cheaper, relatively speaking, it's gone up. So markets go through these periods where you get elevated cost of ownership, but it doesn't last that long, 1 or 2 years, and then it snaps back. Now, I don't know why it'll snap back necessarily, but I can guess. And I just want to show you this. So this is inflation and interest rates over time. And this period is very analogous to the 1940s. The reason it's not like the 70s is because the 70s was the baby boom period. And this is where you had a cohort of people who had to buy things like houses, cars, etc. And they ended up inflating asset prices because there was such huge demand for a new build and just for everything really because this band of people were coming through. It's like long-term demographic stuff. Long-term demographically, what's now happened is that these people who pushed up the market here are getting older, and now we actually have population decline as a risk. But anyway, that aside, it's just overall it's better to look at the 40s. And what happened in the 40s was you had supply side inflation, which is exactly what we have now. And inflation, the way it works is it comes in waves. So you get a wave of inflation and inflation numbers go up. Then what happens is you get over time, then inflation subsides. In other words, you don't get continuous waves, but remember that inflation is cumulative. And what then happens is that that eventually it subsides. And when it does, you have a mixture of demand destruction. So the reason interest rates go up when inflation goes up is because banks, the central banks, are trying to suppress demand. So they're trying to get people to spend money on interest costs and debt maintenance rather than spending money on goods and property and so on. And so once this happens, what typically happens is you get a lag where people just think it's all over. And we see this in the last property cycle, where people thought that thought that essentially after the crash it was all over, and so you had this flatline period. But if you remember, interest rates dropped massively during this period. So interest rates were low from 2009 onwards. They were basically zero. So why wasn't the market really buoyant? Why didn't people want to buy loads of property and just push on and go for it? Because of crowd sentiment. People just thought it was all over. And so the way I see this working is that we're going to have a correction period. And then once this happens, this is the last property cycle, obviously. Once this happens, then people are going to say it's all over. Interest rates will drop because the Bank of England will want to stimulate the economy once again. And then as an investor, there's your opportunity. Everyone will say it's all over. But as an investor, you look at it objectively and go, right, that's the time to refinance because interest rates are at a reasonable level and I can get my money back out. So if we look back at Martin's deal that he showed us, the 160 property, let's say that needs 35,000 in it. Let's say you buy it at 140, it needs 35,000 in it. So that's 100 and well, let's just do share screen again because we can work through the deal very quickly. And so let's say it's 160,000. It needs 35,000 in it. How much would it rent for?
950.
Because it's two-bedroom property. And so gross rentable yield 585. That's not high enough for this area.
No,
so
it's a 3-bedroom, but it's not in the best location. And here the property doesn't rent so
yeah.
high.
And so the rule of thumb is that if the location isn't good enough, or worse area, higher demanded yield. That's roughly how you go with it. And there's a very simple reason. The worse the area, the worse the tenant, the higher the risk. So effectively, if you take it on a big scale, if you look at, say, a really bad area like Bradford or parts of Liverpool, you would have to be getting a 10% yield to cover all the risk of bad tenants, damage to property, etc. So essentially, that's the correlation. So the better the property, better the area, the lower the yield you'll accept because the lower the risk of trouble. It's just a simple equation. So in this case, we say that, for example, here, we know that the area is reasonably good, but it needs quite a lot of work. So maybe the real figure, maybe the real figure for this property would have to be 135,000 in order to get over 6.5% gross rentable.
Yeah, and also this property is modified. Basically, the bedroom, it was bathroom, and they move it as a bedroom, and also they make a bathroom on the ground floor. So
yeah,
that's why.
So it's got issues.
So this property, that's why it's like to sell it for cheaper amount.
Yeah, and therefore it's a very simple equation. If hypothetically you as an investor, you say to us, yeah, we're interested in this one. Okay, so we'll go and talk to the agent and just wait it out. And maybe the vendor will sell, maybe they won't. But we'll talk to as I say, we'll find out. And If they might do because they're getting no interest and they need to sell, well, then great. We'll eventually hit that 135 number and then it's time to go. The other point about all of this, which a lot of people don't think about, is that we are now very experienced with renovations. So we have done loads of them. I think we've got maybe 6 or 7 on the go at the moment, for example. And we've got really good contractors working with us that really know what they're doing and are really reliable and work to a very high standard. And we have a very well-defined process for renovations, which I talk about on the website. So the point about that is, yes, you could get a property cheap, but can you get it renovated? Probably not, but we can. And that's part of why we're worth it, in that we'll identify the properties that are the right ones. We'll do the legwork for you and we'll negotiate because something we've done an awful lot of, me in particular, because I'm the guy who does the negotiating. And by now, most of the agents around Manchester have dealt with me. And I don't try to be their best friend or anything like that. I just do my best to be professional with them. And I hope they like working with me because I'm straightforward. And I think I save them time and effort and they can trust what I say because I say it like it is with them. But I also know that I'm reasonably good at negotiation based on evidence. I've always got a lot to learn, but I do my best. So the point being that we can identify properties that are the right ones to go for, play the waiting game with the agents till the price is right, then negotiate efficiently or effectively, and then finally get the renovation done. And then it's a waiting game to get refinanced. And as you see from history, history never repeats itself, but it certainly rhymes. And the 1940s is a very close kind of rhyming period to where we are now. And I'm very confident interest rates will drop and you'll be able to refinance, get most of your money back out. And in the meantime, you'll enjoy a very good net cash return. And a typical net cash return on a nice average property in reasonably good order should be 4.5% pre-tax, which I think is pretty sound. Now, once you factor in capital gain, which will eventually return, then you're in the double digit figures. You're in 10, 15% a year, something like that. It gets kind of crazy and unbelievable at that level. Plus, of course, rental demand continues to be astonishingly high. And as you probably know by now, as a sophisticated investor, that rent goes up in line with inflation. But
Yeah.
interest rates, they sometimes go in line with inflation, but generally they don't. But in this case, you would be buying for cash. So you don't even have to think about interest rates. You just enjoy rent inflation because rent goes up in line with inflation. And there's a lot of inflation for a while. So there you go. That's it from me. Any final comment from you, Martin?
Yeah. Contact me. I have a new WhatsApp number, so um, we can discuss and find you the best deal.
Yeah, and actually, you know what I just forgot to say, just to reiterate, so there's avoidance of doubt, etc. The process is we find properties, we share them. You see properties you like, contact Martin, and then I call the agent, and we start to just feel what's going on. We report back to you. If we think if the target yield is right and if you're happy with it, we then organize a viewing and then we start negotiations. So that's the process. It's really simple. And already we're seeing results with other clients on this. So there you go. Time to buy with cash.